Hello and welcome. You are watching First Tick here on News 9 Live. I am Krishnakumar. And it's been another day of a great opening for India's stock markets. As we're talking, Sensex up over 230 points. Nifty continues to be above the 21,250 mark. Bear in mind, India's stock markets opened on a positive note and closed on an even better note yesterday, all in the back of all the interest rate commentary coming in from the US Central Bank, US Federal Reserve. There you go on your screens. Nifty up 0.37%, Sensex up 0.32%, Nifty above the 21,250 mark, as I've been telling you. Sensex above the 70,700 mark at this stage. Nifty mid cap up 0.4%. Nifty small cap up 0.85%, nearly 1%. So all in the green. India's volatility index, VIX, down 0.24% at 12.30. So volatility remaining within the comfort range of 12 or so. Another fantastic opening for India stock markets. And to talk about that, we have a very special guest joining us live on First Take this morning. We have Devang Mehta, Director, Equity Advisory, Spark Private Wealth, joining us live. Devang, thank you so much for taking time out to be with us here on First Take on News 9 Live. Pleasure to have you over here. What a day to have you also, right? We've already been on a great bull run that got even further with the state election results in India. And then comes all the commentary from the US Federal Reserve about pausing interest rates and a possible interest rates coming soon. And Indian markets again giving a double thumbs up.
Hi, Krishna. Thanks for having me on the show. Good morning to you and all the viewers of News 9. Yes, I think it's a fantastic day to be on your channel as always, and probably yes, we have seen the U.S. markets as well as the Indian state elections, U.S. economic behavior, in the sense that whatever was talked a couple of days back, the Dows are back at the Fed. That's what it's so I think probably what we are now seeing is 2024, at least 3 rate cuts are at least admitted into, and the market expects a lot more than that, actually, to be very fair. I think, yes, somewhere across the world, we now feel that the rate hikes are done with. We are going to experience rate cuts across. Yesterday also, we saw a couple of banks indicating that across the globe. My sense is that it's all the confluence of factors in India, be it sentiment, be it liquidity from the domestic investors, and of course, India being at the top of the spreadsheets for all the foreign investors. I think flows are going to be expected, are expected very soon rather than later. So I think it's a lot of factors, and it's an earnings-led rally. Market is the slave of earnings. That's what I always call. So either there is a PE re-rating, or the earnings or the EPS has to grow. So PE re-rating has happened. Now the earnings are also coming back, and there is again some bit of re-rating on the cards on the political front. So yes, I think it's getting good to better, in a way, better to good, if you can say, put that word.
Right, better to good is where we're going. And look at all the sectors, Devang. Literally every single sector is up in the green. You're talking about good corporate results. At this stage, the only question I have to ask is: are there any chinks in the armor as far as India stock markets are concerned? Because it is what has been described as a Goldilocks scenario, isn't it?
It is a Goldilocks type of a scenario. Probably we don't know what would come, because it can't be so hunky-dory, right? It's always, there is a conspiracy theory that is in the minds of a lot of market participants, that everything, right from sentiment to liquidity to macros to micros, I think it's a confluence of factors which is helping us. What can sort of distort the rally? Difficult to think right now. But yes, there can be a bit of geopolitical tensions. There can be again crude, which can be a deterrent. Right now, it's not playing a spoil sport at all at around 70. But I think a bit of geopolitical tension or something that the US markets or the global markets correct, and India probably get an after effect of it. That can be one bit of a deterrent. Otherwise, I don't think there are much chinks in the armor. The only thing again is that if the earnings cycle or the capex cycle, which we are talking about, if there is a disruption to that, yes, that can be a bit of a disruption in the rally. Otherwise, I don't think there are many factors which can sort of come and disturb the markets. Yes, at a given point, there can always be 5-7% correction after such a fast and furious rally. But I don't think there will be a larger correction seeming on the anvil.
Okay, there is no larger correction on the anvil. So how is, at this stage, how is a retail investor supposed to sort of pace himself or herself, in these markets? Because all of this is coming on the back of a strong 6-month-long bull run. And even 3 months ago, we were talking about the fact that there is a possibility of a dip at the end of the year in December, or probably even at the beginning of the year, January. That's the dip to buy in. Where are the dips, Devang? It doesn't look like there's any dip for, if somebody hasn't entered the markets in the last 6-7 months. My question is, are the markets now overheated for anybody to enter at this stage?
I think it's the scenario or rather the time frame that you look at, right? If you ask me for a month or a couple of months or a quarter, it's extremely difficult to say what is going to happen, right? It's just a crystal gazing that one indulges into if I make a comment about a quarter or a couple of quarters. But if somebody is in for the longer haul, probably the next 3 or 5 years, there are going to be dips in the market, right? There are ebbs and corrections in the markets are always a phenomenon that you experience during a structural bull market. So my sense is that you probably will encounter such dips. But what happens is if a dip comes in, there is always a larger dip which is expected, right? It's a fear and greed type of a environment that we deal with. So everybody, when the dip comes, people will say it's going to dip a little more further, and then that's why you can't enter. And that's why I always tell people that sometimes it's fear of missing out, and sometimes it's jogi, a joy of getting in. So FOMO is now sort of converted into jogi, which is called a joy of getting in. So in fact, what I'm making out, Krishna, is that every level is a good level to enter. And why I say that, because sometimes it's very bad to be left out in this type of a market. And as I said, if you are here for the next 3-5 years, if you are going to experience a structural bull run, India getting into a good corporate GDP growth, India getting into earnings growth, yes, smaller dips should be sort of got into, and don't get carried away by the markets, right? So there's always a tomorrow. So don't always get carried away by the markets. So that's also one thing I would advise to the retail investors.
Don't get carried away. You can't time the markets, and it's the first time I'm hearing this, Devang. Jogi, I know FOMO, but Jogi, this is the first time I'm actually hearing anybody say it. So that's like an inspiration for me to deal with the markets going forward. But the question here is, if I were to ask you, look at where the Sensex is right now, 70,007 or above 70,700 this morning. Nifty about 21,250. I mean, Nifty just scaled the 21K mark, and it looks like it's not coming down below the 21,200 mark already. Where do you peg the Sensex and the Nifty in 2024, Devang? I mean, I'm asking you to do crystal ball gazing again, but if I were to...
Yeah, so I would, just for the sake of, I think, very easily put it on the Excel sheet. I think if you just dissect the earnings, if for the next 2 years, which is, I think, a scenario which we can all visualize, if the index or rather the earnings growth of Nifty or Sensex happens at around, say, 13, 14, 15% or mid-teens type of an earnings growth, which is what the consensus is expecting. Let's be a little more conservative. Consensus is above 15%. If we put at 13, 14% type of a target, I think for the next 2-3 years, Nifty can return you 13, 14%, and there will be individual pockets, right? There'll be sectors, there'll be themes, there'll be stocks, businesses, which would return you rather more than even that. I think the first target which we should keep in mind, and as I again said, I'm not a fan of targets, I'm not a fan of records, because records are made to be broken, sort of, right? So the first target seems in mind is 75,000 on the Sensex, right? It's quite close. 75,000 is what I think we call a diamond jubilee or something, which we are very close to. So that's the first target which one should keep in mind. And as I said, yes, if we grow at 12-15% type of earnings growth is where we should focus rather than the index targets. Index will not make money for you. Your businesses will make money for you.
Oh, yeah, absolutely. I was only asking because for all those retail investors out there who are investing in the indexed funds, index mutual funds, just to get an idea of where. Because look, the question here is that because they are S&P, Dow and Nasdaq, Wall Street is scaling record highs on a daily basis, and so are the Indian markets. So from that perspective, I was asking. But if I were to ask you a strategy for investors in the year 2024, how are they supposed to go about it? Any particular themes that you think they should be picking up on?
Yeah. So I think what I make it a little easy for the investors as well as the viewers. There are certain themes which probably look very interesting. So I call it generally 5 C's. The first C is what we are seeing right now is something called the capital expenditure, right? The capex cycle. Everybody talks about it. The capex cycle has started. Government is doing a lot of capex and sort of boosting infrastructure across urban areas, across rural areas, across semi-rural areas. I think this is one part which is very important. And with that, even the private sector capex has come back to the fore. So this is something which one should keep in mind. The businesses which are in the sectors of capital goods, infrastructure, bearings, There are a lot of such allied industries, power ancillaries. All this can be kept in mind as a capex theme. The second C is again consumption, right? So India has traditionally been strong on consumption. So urban consumption, premiumization, aspirational Indian. This is a theme again which is very important to keep in mind. So something in discretionary consumption is very important. The third C, which I call, is credit growth. Right, India is experiencing a good credit growth. 2003 to 8, we saw a wonderful credit growth cycle. We are experiencing that type of a 14-15% type of credit growth, which is the lending which the banks do to the corporates as well as to the retail audience. So that's also a good number to start off with, where you can play it via a lot of private banks, a lot of NBFCs. These are good sectors to be in. So these three C's can lead to the fourth C, which is corporate earnings and cash flows. Very important to also look at corporate earnings, and the fifth one being free cash flow generation companies. So rather than getting into companies with huge debt, get into companies which are clean in terms of the balance sheet, clean in terms of the corporate governance. So this 5 C's, ideally, if you take care of a portfolio of 15 stocks probably, or 15 businesses, could serve the purpose for the next couple of years at least.
All right, so 5 C's. I learned 2 things this morning with you, Devang. One is Jogi, joy of getting into the markets, and the second is 5 C's. Apart from this, the only thing I have to ask you is all the buzz surrounding IPOs. Just this week alone, we have 7 IPOs hitting the markets, 2 listings, and new listings of say a month ago are giving phenomenal returns. So a lot of questions in the minds of investors as to which IPO to get into, but at the same time, lots of talk around, I've applied but did not get anything allotted. How do you play the primary market game?
Be actually on merit. I think, see, what happens is a secondary market doing very well also pushes the primary market sort of into good territory. And whenever the secondary markets are good, normally even the promoters come in, sort of try and cash in into the IPOs. Having said that, the quality of paper that we have seen over the past 2-3 weeks, be it Tata Technologies or IREDA or a lot of such IPOs which are right now doing very well. There are 2 things one should look at: the business model of the companies. It shouldn't be applied as just a lottery that in the next 3, 4, 5 days, if I get an allotment, I would make a cool 20, 30, 40, 50%, which is the case right now. But ideally, I think one should look at the business. Is there a peer available in the secondary market? If there is a good peer available at a reasonable valuation, that should be the place where one should go to. And if the IPO is really good, as I said, the quality paper right now is coming into the market, and a lot of people are leaving something on the table for the retail investors as well as the HNIs in the Indian market. So I think the IPO flow right now is good. It's not euphoric as such. A large IPO coming in and sucking out liquidity is always difficult for the secondary markets. Right. But yes, as I said, do it on merit, and just don't do it for the sake of listing gains. That's what my advice would always be.
All right, fair enough. You have Devang Mehta, Director, Equity Advisory, Spark Private Wealth, giving you all that knowledge to help you decide what to do as far as India's markets are concerned. Devang, it's been a pleasure talking to you here on First Take on News 9 Live. Great having you, and hope to keep having you as often as possible here on News 9 Live so that our viewers and investors get all the clarity that they need in these times. So thank you so much for taking time out to be with us. And with that, it is time for a short breather, but here's an important programming note. Coming soon on our News 9 Plus platform is a story called Battling the Bias. Do credit ratings really matter? While India is the world's fastest growing major economy, global ratings agencies have placed it just above the junk grade. India has never defaulted on debt repayments, and its dollar reserves are at a record high. So are these agencies being fair, or are they biased against India?
Is there a bias in favor of the developed countries and against developing countries and emerging market economies? The answer is patently clear. There is such a bias. It's a documented bias.
It has taken a very interesting and insidious turn. If you ask them how they do it and you go into their methodologies, you will see they're completely non-transparent.
I am a strong believer that all these agencies, their business is in the business of credibility. So as long as investors are making money, if they don't upgrade the ratings, they would end up, facing a credibility challenge.
This and more streaming now on the world's first news OTT, News 9 Plus. Download now.
Hello and welcome. You're watching Business Plus. I'm Shweta Kothari. We're bringing you stories from the world of business, policy and economy. First up, let's begin with headlines. KPIT introduces India's first sodium-ion battery technology as an alternative to lithium-ion batteries. New technology set to lower